Black Scholes, Merton. So pay attention to it now. Okay, this is pretty straightforward here. Remember what I said earlier, all rates or all returns are quoted annually. So how do we get an annual rate from a particular period? It is just 1 plus R being the period rate, to the power of 365 over that particular period. So let's say that we had a 43-day return. How do we get an annual return? It's to the power of 365 over 43. It is whatever rate we got over that 43 days, that's our holding period return, to the power of 365 over 43. The logic here is, how many 43-day periods are there in 365? Let's say it was for 540 days, longer than a year. Well, same thing, 365 over 540, because this will be less than 1, right? So that the return will be brought down to be annualized. If it's daily, power of 365, our R is a daily return. If we had a 1-week return, it's the power of 52. If we had a monthly return, the power of 12. Quarterly return, the power of 4. So that's fairly straightforward. 7 days in a week, 365 days in a year, 52 weeks in a year, which is not entirely true, by the way. There are more than 52 weeks in a year. Most people don't seem to understand that. 7 days a week, 52 weeks a year is 364 days. A year has either 365 or 366. So this is not entirely true. That if you had a weekly return, if you had a 7-day return and you calculated a weekly return, then a weekly return you calculate an annual return, it would not equal the same as if you had used 365 days, because this will only amount to 364. Just something to be aware of. Typically, now notice I've used 365. I've used 52, 12, 4. Typically, there are 250. We round it out to about 250 trading days a year. You got 365. You've got 52 weekends in there. So you take out 104 days. You'll get to 261. And you've got roughly about 10 to 11 holidays. Every month has a holiday in it somewhere. So you get about 10 to 11. I think there's a couple of months with no holidays, but you get about 10 to 11 holidays in there. So usually it's 250 trading days. We think about it as 5 days in a week, 20 days in a month. Sometimes you'll see 21 days used in a month, 250 days in a year. This is becoming less and less true because of digital assets. They trade 365 days a year. Not only that, if you have a fixed income portfolio, interest accrues over the weekend. So it really comes down to convention. So just be aware that in different contexts, you might have different day count conventions. When it comes to fixed income, you'll see a lot of different day count conventions in there. How the day count convention is not that important. If it was an important thing, then this would simply change to 250, and this 43 days would be 43 trading days. So if it says so many trading days, then your numerator should be the amount of available trading days. But if it just says over 43 days, well, there are 365 days in the year. The context will make it clear. Annualizing returns can be misleading because it assumes that returns can be repeated. So let's say that you buy something on Monday and it was a great week, and on Friday you sell it 5 days later and you got 8% in 1 week. Well, annualizing it to say this is my return on an annualized basis would be misleading, because the question would be, yeah, but can you keep getting 8% every single week? Probably not. So it can be misleading, especially when you have periods with really bad performance or really good performance. Continuously compounded returns. Look what we've done here. Let's work our way backwards. Quarterly is to the power of 4. Monthly is to the power of 12. Weekly is to the power of 52. Daily is the power of 365. Well, maybe if you go hourly and then you go by the minute, then by the second, well, it'll eventually limit out at a particular type of function. Well, what does that look like, right? That looks like Euler's constant. So we can use a continuously compounded return, which is just our ending price over our beginning price and then we take the natural log of it. So let's say that we had an ending price of 105, a starting price of 100, take the natural log, it's 4.879%. So what is that saying? It's saying that if we invested $100 and we earned 4.897% compounded continuously, we would end with 105. So an annual rate of 5% is equivalent to a continuously compounded rate of 4.879. And we can always get to it by simply just taking whatever the interest rate is, 1 plus R. Whatever annual interest rate we have, we can take the natural log of that. We get to a continuously compounded rate. To get back to an annual rate, whatever continuously compounded rate we have, it's to the power of E. E to the power RC minus 1 will get us back to 5%. So we can see that if we put 0.04879 in our power term for Euler's constant, you get back to 5%. This right here, keep that in mind. You're going to see that later on in Black-Scholes when we look at the numerator for calculating a z-value is going to be the natural log of ST, whatever value we have, over some strike price, ST over X. Well, that is this right here. All this is giving us is a continuously compounded rate. Okay, hit the examples in the reading. We're done this learning objective. Nice and painless, right? We're done this learning objective. It's not a difficult one at all. Go through some of the examples so that you get that muscle memory, and we'll pick up with the next one when you get back. Next learning objective, another calculate and interpret for you. Calculate and interpret major return measures and describe their appropriate uses. Okay, the first type of returns here, gross and net returns, typically reported by funds. A gross return is the return that the fund earns before any deductions for management expenses, custodial fees, taxes, and so on, but after trading expenses. It's basically what the fund earns. So let me see if I can give you an easy way to try to remember this. Let's say you start with $100 and at the end of the year you end with $130. Your gross return is basically 30%. It says after trading expenses. The trading expenses leave the account. But the management expense, custodial fees, taxes are paid out of the particular return. They don't leave the account until the fund manager actually pays them out. But when you trade on an exchange, you have exchange fees. They leave the account that day. So what you're left with at the end of the year is already the amount after trading expenses are gone because they leave the account. Out of that $30 that you made, then you would pay your management expense, you'd pay your custodial fees, you'd pay your taxes, and so on. So the gross return is what you have, what the account ends the year with before any disbursements that didn't involve trading expenses. This is the appropriate measure for evaluating, comparing the investment skill of managers. The reason we'd use the gross return is, let's say that you had two returns. Another one started with 100 and ended with 125, which is a 25% return. Which one did better? Well, the 30%. But what if this one has very high fees, high management expense, high custodial fees, inefficient in the form that it generates taxes, and after you have all expenses taken out, you're left with 10%, but this one is very efficient with low fees and you're left with 20%. This 10% and this 20 reflect the cost to the investor of choosing that particular manager, but this return represents the particular skill in that manager of earning a return. So when we're evaluating, comparing the investment skill of managers, we compare on gross returns. The net return is what the investor actually earns after all the expenses are paid. Pre-tax and after-tax nominal returns, the default is to report or state the pre-tax return, and that is very simple. If you and I were investors in a fund, the fund would not state the after-tax return because my tax rate is very different than your tax rate. And if you have 100 people in the fund, you might have 30 different tax rates going on, so that there is no one after-tax return that you can state, because everybody's tax rate is different, right? Each investor's marginal tax rate may differ. Now, the components of the return may be reported so that you may then calculate what your after-tax return is. So it might say, okay, well, we had a 10% return, 2% was in dividends, 1% was in interest, and 4% was in realized capital gains. So then you can calculate what your after-tax return is based on what your tax rate is, but it would be very difficult to quote an after-tax return that was appropriate for everybody, because you may have a 28% tax rate. I'm in a 53% tax rate bracket. So if I earn $1 of interest, I only get to keep 47 cents of it. You may have a better after-tax return on interest only because you have a lower tax rate. So you can see that it would be difficult to quote one return. Real returns. This accounts for the rate of inflation. So 1 plus the real return is 1 plus the nominal return divided by 1 plus the inflation rate. The inflation rate is typically the period over period CPI, whatever the CPI happens to be. Now, when we get to controlling for inflation, it is a big discussion about, well, which inflation rate are we using? Are we using a headline CPI? Are we using a core CPI? Are we using a PCE, which is a different measure of inflation? Are we using core PCE? Are we using a trimmed CPI? There are many different measures of inflation. So if a firm or a fund is reporting a real return, the first question you should ask is, well, what version of the price index are you using? Because they may decide to use a version of the price index that is most favorable to them, that reports the highest real return. So you got to make sure that that is comparable across funds. If we were all in equities, we have our nominal return for equities. We may want to know what risk premium we got for being in equities. The risk premium is the premium we get up and above what the default risk-free rate is, because we can always get that. Remember, at the very beginning, we looked at a whole bunch of risk premiums. Well, we can take 1 plus our nominal return divided by 1 plus the risk-free rate, and it'll tell us what our risk premium was. In other words, how much more in premium did we earn for taking on that particular type of risk? Okay, after-tax real returns. Again, this is not quoted for any fund because of the difference in tax rates. But what is this measuring? It is the measure of growth in purchasing power of a portfolio. So we have to part with taxes. That's not ours. So the after-tax return tells us how much our portfolio grew. Controlling for inflation tells us what our purchasing power grew by. So if our portfolio grew after tax by 3%, but inflation was 4%, we can actually buy fewer things now than we could a year ago. So we want to make sure that we're preserving the purchasing power of the assets, or even growing the purchasing power of the assets. That is a very big thing for large institutions like endowments, foundations, pension plans. When you get to level 3 and you get more into detail on these, you'll see that that is one of their big goals, is to preserve the purchasing power of their assets. Leveraged returns, because we can always borrow money to get things done. Leverage can be obtained through margin loans, through derivatives. Derivatives have what's called embedded leverage, or through collateralized loans. In fixed income, something called a repo gets you incredible amounts of leverage. So this is the general rule for when to use leverage. If the return that you can get, RP is the return on the portfolio, is greater than the cost of debt, R is your interest rate, D is debt, the interest rate on debt. If you can earn more in an investment than it would cost you to borrow the money, you should do it. Leverage enhances returns. By the way, this is the very basis of something called a carry trade, where you borrow at a low rate and you invest at a high rate, and then you use leverage to lever that up. That is called a carry trade. So how do we calculate our leveraged return? It is our dollar return that we realized divided by our equity. Well, that makes a lot of sense, right? Let's say that you had a portfolio that earned $2 million and you did it on $5 million worth of equity. You have a 40% return. But what if you had $5 million worth of debt? Then your return on capital is 2 over 10, 2 million over 10 million, or 20%. But because you used leverage, you now have a leveraged return of 40%. Now, this is a rather naive way to calculate it. It wouldn't just be double the amount because there'd be some cost to debt. And here is where we calculate the cost to debt. So how do we calculate this? It is the return that we get on our portfolio, let's say it's 8%, multiplied by the capital that we're using. There's the amount of equity and there's the amount of debt, B for borrowed money. So it's our return times how much capital we have minus how much it cost us. There's the value of our borrowed funds times the cost of debt. So this is our total return on all of our capital. This is the cost of getting the debt. The difference is the return left divided by our equity. And it simplifies to this. Now, some people like to know, how did you get from here to here? So I show you. All we're doing is we're going to just separate all of the terms. This is RP times VE plus VB. So it's RP times VE over VE plus RP times VB over VE minus, and then we have VB times RD over VE. So I've just separated these out. Now we're going to collect like terms. Well, these two things cancel out, so you're left with RP. What is our common term up here? We have VB as a common term, so let's take VB out. What are we left with? RP minus RD over VE. And you can see that this final term here is the same as if I had done this, right? It's the same as if I had done that. So if you wanted to know the steps on how we get here, this is how we do it. So let's walk through a very quick example just so you see how the numbers fit together. Let's say that we have a $10 million equity portfolio. And this is sort of the wrong word to use. So let me just make a quick correction here to make it easier for you to understand so there's no confusion. Equities. We have a $10 million portfolio of equities, of stocks. And the portfolio earned 8%, and 30% of this was debt financed at a cost of 5%. Well, let's just remember our formula here. RP, what is RP? Was 8%, 8% plus VB over VE. VE is the value of borrowed funds over the value of equity. Well, we know we have a $10 million portfolio, 30% debt financed, so we must have had $3 million in borrowed funds. That would have left $7 million in equity left. Careful, don't put 3 over 10. It's VB, the value of the borrowed funds over the value of the equity, not the value of the capital. 3 million over 7 million, there's your leverage factor. And then it is the return on the portfolio minus the cost of debt. There is the spread that we made. So it is the leverage factor times the spread we can make. And our return is 9.2857. The portfolio returned 8%. The equity returned 9.2857 because we had leverage in there. And that wraps it up. At this point, you should be, well, we're done the video. I'm not going to say pause, but do the examples in the reading. And then you have the end of chapter questions, which are a nice summation test of everything that you know from this reading.